Hello everyone, my name is Dr. Melissa Cohen, and today we're going to talk about the market correction that's going on. So if you're like me, we've checked into our retirement accounts and our brokerage accounts, and the value is way down, and we're all freaking out. So first of all, let me just kind of tell you what's been going on. So as you know, the market is down, and so right now we're kind of looking at a correction. So a correction, official correction, is when the market moves or drops 10% below the record high. So the good news is there was a record high. If you look over, let's look. I'm looking at the Dow Jones Industrial Average. So just kind of looking at that index of the market here, and I'm doing a 1 year. I hit the 1 year. So you can see a year ago we were right around $30,000, right? And we peaked up here on the Dow Jones to about almost 37,000. So that's really overall a tremendous growth in 1 year. But now we dipped last week down to 34. So within just a couple of days dropped more than a 10%. So therefore there was a correction. Now the good news is, just looking at today and what's going on right now, we're back up to 34,000. So when you think 37,000 minus almost 35, that's $2,000 difference. So that's not a lot. So we went down a bunch, more than 10% within a couple days, but now the market is slowly coming up. Some reasons for that, I don't know why it dipped, but the reasons why it's rebounding, though, is because Microsoft and Apple, they released their earnings last week, and a lot of the tech companies actually is what made it dip. But when Microsoft and Apple came out, they said, hey, we're growing, we've got some great earnings, we're doing well. So that makes the dip go back up. And also we have some additional tech earnings coming up from Amazon, Alphabet, and Meta. So if those companies, they comprise a lot of value, and I don't know the actual percentage of the Dow Jones, but a significant amount. If they continue to go up and they have positive earnings, and that's what they announced, and I think those are coming up this week, then the market is going to shift back up. So what do you do when the market dips like that and it does more than a correction within a week? You do nothing. That's what I want to tell you. You do nothing. Because first of all, the general rule of thumb is the money that is actually in the stock market, you should not need to touch it for at least 5 years. And why do they say 5 years? Because 5 years gives you enough time to ride out the ups and downs. Even if you took your money out at $34,000 last week, you're still going to have a positive return from your money from 1 year ago. It's still going to be up more than 10%. Now I have two different retirement accounts. One with the former employer, and it's still there, and it's a moderate. It's not too conservative, but it's not too aggressive tech heavy. So a couple retirement fund accounts, some Vanguard mutual fund, I think, and so it's pretty solid growth, I should say. Well, I checked it over the weekend because I was like, oh my gosh, my brokerage account went down. I'm freaking out. That one still had, if I did the year to date, not the year to date, if I did the year to date, which was just January 1st to January 31st, it was down like 25%. But if I did a 1 year rolling 12 months, it was still up 10.55%. So first of all, you got to keep that happy thought and not look at the negative. So I still had over 10% returns for the year. And let's just take a chill and go back to 2 years. We had this big drop in March of 2020, right? That's right after the COVID closures just happened globally, right? And there was a big fall, and I don't know if that was a market correction, that was an actual response to what was going on in the world. But prior to that time, it was not even up to 30,000 yet. Let's see, let's do 5 years. So up until that March 2020, the high for the Dow Jones was 29,000. Then we had that big drop, right? Almost 25-30% in just a couple of days, and then it slowly climbed back up. So looking at a 5 year account, 5-year times period, let's go way over here. We're looking at 20,000. So for 5 years, you can see that overall the growth has gone up. Now I found this on NerdWallet, but there's different people, different companies have actually done this. Why should you not be concerned about the drop? Because historical average of the stock market is 10%. It was 8%, but then we've done so well in the last several years, it's actually gone up to 10%. So they are tracking that from the first day that the stock market was invented. So it's over 100 years. They look at the average annual returns of the stock market. So historical average annual returns is writing about 9 to 10%. There are years it went down, and there are years it went up. So, the financial crisis starting in 2008, September 11th bombings, the Great Depression when it went down. There's different life events or historical events, global events that happened that made the market drop, even in March 2020 with the global COVID pandemic there. So that went down, but it also went up. So your 5-year time period of, if you need the money in 5 years, it should not be in the market. And that's so that you can ride the waves ups and downs. Can't time the market, don't recommend that, all of that sort of thing. So if you're still looking for a 10% return, you're probably not a fortune teller, future teller is going to get it. But the average historical return is 10%. I heard 8 to 9. Since the market did so well last year, it's up to about 10% here. So what does that mean? That means you keep your money if you're a long-term investor, you just keep your money in the market. If you're going to retire and you need the money within the next 5 years, you need to start figuring out your plan to get the money, or to sell your stocks and get the money out of the stock market and move it to a low risk account. The stock market is pretty risky. That's why you need the time period, the longevity of about 5 years to ride the ups and downs. All right, and the other thing to note was, if you go and look at your balance on your bank account, I'm guilty of it too. I'm like, oh man, I'm doing great. My account's rocking. I feel good today. But that's paper money, because I haven't sold my stock. So I only have what the perceived value of that stock is for that day. And that's how much money is in my account, right? So if I sell it today, if I sell it at a low, and I sell it lower than what I bought it, I'm going to take a loss. All right. So if I don't need that money for 5 years, at least I'm going to keep it in there. I'm a long-term investor. So that's what I'm looking to do. So you only lose the money of that stock when you sell it, if you sell it now at a low. And so the general rule is buy low, sell high. So if you panic sell, you're definitely going to lose your money. That becomes a solid sell, and that's when you actually lose your money. So remember, the historical average is about 9 to 10% since the market has been in existence, and writing out all of these different historical dips and such. And remember, looking at the 5-year, that was the high. The 5 years ago, the high was only 20,000. Now we're up to, our super high was 37,000 and change. Today we're going up to almost 35,000, and hopefully it'll continue to go up. So don't panic sell. And also, here's my disclaimer: I am not a financial advisor, so definitely look out. Consult with your financial professional, whether it's a tax advisor, CPA, attorney, whoever helps you, makes the best decisions for you in your situation as well. If you have any questions, feel free to join me at smartandsassymoney.com. Thank you.